America's credit score has been lowered. Belle the Planner here with your 1-minute economic update. Last week, the U.S. lost its last AAA credit rating. What does that mean? There are 3 credit agencies that assess the riskiness of a country's debt. Essentially, they give a score of how likely it is that the country will default or not be able to pay on their debt. 2 of the credit ratings agencies had already lowered the U.S. ratings from the top to one rung below, but one agency, called Moody's, still held out. That has now changed. Moody said that they lowered our credit rating because the U.S. government has not and is not doing anything significant to reduce the gap between government spending and government income. The result, they predict, is that the U.S. government's debt will continue to increase and at a faster rate. So, how big of a deal is this lower credit score? Well, it's not a good sign. We are still dealing with the fallout of the trade war, which put the long-term stability of the U.S. government and our financial markets into question. Every time something like this happens, investors shift a little more out of U.S. investment, which lowers the demand for our bonds and treasuries. And as a result, interest rates rise in order to attract buyers. Those interest rate increases end up doing 2 things. Number 1, the cost of the U.S. government's debt goes up. The budget deficit is funded by the selling of U.S. bonds and treasuries, and the government pays interest to investors. As a result, as the rates go up, the amount we have to pay our bondholders goes up as well. Number 2, those higher interest rates trickle down to other rates in our economy, like home, business, and car loans. It essentially makes it more expensive to borrow money. Making all of this worse, really big investors like central banks are starting to look around the globe for other big, stable economies to invest in now that America's reputation as a stable investment has been questioned. Right now, Congress is working on a giant tax and spending bill. The bill is expected to increase budget deficits by over $3 trillion over the next decade, which is not a step in the right direction when it comes to lowering our national debt and increasing our credit score. Follow me, and I'll keep you posted.